Um, Thank you so much to the chair and co-chair and the advisor of our Capital Markets and Investor Protection Committee to come out with this kind of program. We know it's for the niche audience, and we do understand. At the Federation, we are always mindful of, curating and organizing programs that support the entire ecosystem, as well as support our members and the international businesses to thrive. And be sure that today the exporter, importer, and the trader members are going to make utmost benefit out of this program. Before we begin the session, we would like to show a short film of the FTCCI.
The largest business organization of Telangana state. With a legacy of excellence, the voice of the industry, representing the interests of 25,000 businesses of all sizes, sectors and regions. Empowering trade through advocacy, solution and standard setting. Opening new avenues for unprecedented growth. Laying the foundation for an industrial transformation in the state of Telangana. Now, poised for the next century and beyond. The Federation of Telangana Chambers of Commerce and Industry, FTCCI. Together, let's rewrite the vision for a progressive future.
Thank you so much. I invite our Senior Vice President, Mr. Anil Agarwal, to deliver the welcome address.
Good afternoon, Mr. Shivam Chakravarti, Senior Economist from ICICI Bank, Abhishek Gaud from National Stock Exchange, Mr. Arpan Jain from ICICI Bank, Maheshwari ji, our Chair for Capital Market and Investors Protection Committee, Prem Kankaria ji, Chair for Banking, Finance and Insurance Committee, and our Vice President, Mila Jaydev ji. Good afternoon to all the speakers from ICICI and National Stock Exchange, Managing Committee members, past presidents, and our valuable participants. I welcome all to the knowledge sharing session by the leading bank, ICICI Bank, and leading stock exchange, National Stock Exchange, and appreciate their endeavor to partner with FTCCI for such an awareness program. Global economic outlook is of prime importance for international traders to take strategic decisions. There are several decisions in any businesses which are reliant in international market. The current shortage in the semiconductor worldwide is impacting almost all the countries and businesses. The interdependence of the economies in procurement of goods and services to synergize and procure better products and services are propelled by the facilitators like banks and stock exchanges. They provide platforms and tools to make the exchange of different currencies in lieu of goods and services safe and secure. They create an ecosystem to thrive international businesses in more effective manner. For stakeholders operating in the foreign exchange market, the inherent challenges of forex trading are well known. The forex market is the largest and most liquid in the world, with a daily volume of $6.6 trillion, according to the 2019 triennial central bank survey of foreign exchange and OTC derivatives market. Trading currencies means dealing with constantly changing prices. Every second, the buying or selling rate of a given currency changes. Such volatility can hurt operators' investments, resulting in significant losses for the company as a whole. Forex risk is an inevitable byproduct of the international traders and forex market participants, but one that can be mitigated by effective hedging strategies prior to trading. It is important to emphasize that hedging practices are not meant to generate profits, but rather to protect the company and to avoid substantial losses. It is a way to ensure that no money will be lost because of exchange fluctuations. There will be a deliberations and presentations on today's subjects, that is global economic outlook, Indian economic outlook, and hedging solutions for managing forex risk. The participants can always keep their inquisitive window open and ask relevant questions, and from the speakers to make these sessions more meaningful and knowledgeable. Wish you all the best. Thank you.
At an outset, sir, I would like to convey my thanks to Mr. Anil Agarwal, our Senior VP, for such an insightful and welcome address, which has really set the tone for the event. Now, I would request Mr. Krishna Kumar Maheshwari, Chair for Capital Market and Investor Protection Committee, to address the participants with the introductory remarks.
Thank you very much, and to Mr. Anil Agarwal, Senior Vice President, Meela Jayadev, Vice President, Khayati Naravane, CEO, FTCCI, and a warm welcome to all the participants who have logged in for today's webinar on Global Economic Outlook and Hedging Forex Risk. According to Global Economic Outlook and World Bank report, the global growth rate is expected to decelerate in the year 2022 to 4.1% from 5.5% of 2021. Emerging markets are likely to experience a slower recovery rate compared to developed economy due to supply disruption and high energy prices. The inflation is expected to remain at elevated level throughout the year. To speak on global economic outlook, we have with us Mr. Shivam Chakravarti, Senior Economist, Economic Research Group, ICICI Bank, and also Mr. Arpan Jain, Team Lead, Market Group, Corporate Markets, ICICI Bank. Hedging is used by businesses to manage their currency exposure. If a business needs to buy or sell one currency for another, they are exposed to fluctuations in the foreign exchange market that could affect their cost, or revenues, and ultimately their profits. Cost of hedging through the exchange platform is minimum in terms of brokerage that is required to be paid, transaction charges, and the margin money that is required to be put in to hedge the risk. And it is always advisable that this cost should be paid and the risk hedged. We are a part of the global economy, and any change in the price in other markets world over has a bearing on the prices in our own country. For SME, MSME, and traders who have exposure in foreign currency, it is important to hedge one's exposure to avoid unforeseen losses, or otherwise they could be prone to high risk, which may also result in a transaction made for profit, resulting in a transaction in a loss, and at times can also affect the business viability. Banks and institutions who have exposures to the institutions insist that their transactions are kept hedged so that they are safe and the bank is also kept safe. Exchanges in India offer futures and options contract in currency segment, and from December of 2020, weekly futures and option contract have also been made available, and this is keeping in mind the maturity date of the transactions that are to be done by the SME and the obligations of the traders. To speak more on currency hedging, I have Mr. Abhishek Gaur from the National Stock Exchange, who is Senior Manager, Business Development Portfolio for the Southern region, who will speak to us on that. With this, I open the house for Mr. Shivam and Mr. Arpan Jain to speak on the global economic outlook and also Mr. Abhishek on currency hedging.
Thank you, sir, for such an insightful and thought-provoking speech, which has ignited the quest to learn more on the subject. Now, to brief us all about the global economic outlook, we have with us Mr. Shivam Chakravarti. He is a senior economist, economic research group at ICICI Bank for more than 4 years. He has a vast experience of more than 15 years as research analyst and economist in prestigious organizations like Economic Times and HDFC Bank. Now, I request Mr. Chakravarti to take the session ahead.
Yeah, hi, thanks a lot. Sorry, I've got a slight sore throat. I've just recovered from COVID, so you just have to bear with me. I'm better to talk. Yeah, so thanks a lot for that introduction, and I thank you for inviting ICICI Bank out here. So what I'm going to do is I'm going to just share my presentation, and I'm going to quickly cover our global macroeconomic expectations and then get into India, and I'll cover our market expectations as well. I'm assuming this can be seen, right?
Yeah.
Yeah.
Yeah, okay, thank you. Now, one second. Yeah, all right. So just to get quickly started, I will cover the macroeconomy aspect, and then my colleague Arpan Jain will cover the hedging strategies and other aspects that you might have in mind. So just a quick update in terms of what we sort of expect global economy. So what we've done here is that we've just presented our in-house growth forecast that we have for 22. We have also shown the previous forecast for 20 and 21. 2020 was obviously a write-off year, but with the exception of China, every economy contracted at a record pace. It was an unprecedented synchronized contraction. 2021 in many ways was a revival from the synchronized contraction and a normalization of economic activity. US economy, developed markets and developed economies actually grew at a much faster pace relative to their trend level, primarily reflecting the kind of fiscal stimulus that was delivered, particularly in the US. We had a record 25% stimulus delivered by the US, of which 10 to 11% was in the form of direct cash transfers to households that propelled sharp rise in consumption and durable goods consumption in particular. And subsequently, going into 2022, we after a fairly strong growth of we estimate to be about 5.6% in 2021, we see growth slowing a little bit. What we do is every quarter we review our forecasts and we monitor the kind of revisions that we make. So from September 2021, our expectations for 2022, we have lowered our expectations to 4.7%, primarily reflecting a short-term hit from the Omicron virus in Q1 2022, and the fact that we have a much lower US fiscal policy in US is going to be much less than what we saw during 2021. And we are also in the midst of a very weak showing in China. China is going through a structural slowdown, which I will touch upon briefly as well. So for those reasons, we've downgraded our forecast. US, we have downgraded sharply from 6% that we thought would happen in 22 to 3.9%. A lot of this has to do with the fact that two things actually. One is, of course, the Omicron hit, which in Q1, it's showing up in the December high frequency indicators in the US. There is a huge fall, in retail sales, industrial production, which we think can continue into January and February. But we also expected a little more fiscal policy support from the US government, which has not really come in place, although they have passed an infrastructure stimulus bill. That quantum is still fairly modest, in terms of the allocation for 2022. It's only about 0.1% of GDP or so. So that's why we have lowered our projections. Eurozone, we've kept relatively flat. So Europe actually contracted a much faster pace than US during 2020, mainly because of the lockdowns that were imposed. So the revival in 21 has got to do with with negative base effects that were in place. Eurozone growth, we think, it will grow at a fairly good pace of about 3.5, 3.4%. Primarily after the hit from Omicron, we see a fairly strong, robust pace. We also think that fiscal policy will remain fairly expansionary in Europe. There is an EU recovery fund that is supporting countries like Italy, Spain, Portugal, which we think will remain in place. And UK economy as well, we've lowered our growth projections, mainly reflecting Omicron. There's also some hit in terms of production capacity taking place because of Brexit. So those are the factors where we think will be slightly lower. And UK, actually, the Bank of England, we estimate to be a much more aggressive and tightening policy. So that effect and hit of that will also show up more prominently. Japan has delivered a slight fiscal stimulus, but it's still around 3%. It's still fairly modest compared to the other regions. As far as emerging economies is concerned, I think we need to differentiate between China and EM economies, excluding China. So as far as China is concerned, we have lowered our growth projections quite sharply. We actually see Chinese growth at about 4.8% for 2022. Key reason for this downward revision is the fact that they are in the midst of a huge real estate slowdown. Similar to what happened during Lehman Brothers, similar to what happened in India during the IDFC episode, there is a huge asset liability mismatch happening in the real estate sector. There has been, for the last 10 years, substantial amount of liquidity support that has been provided and government support that has been provided. That has resulted in a huge pileup in leverage. A lot of these companies have also raised dollar bonds quite aggressively. So, for instance, Evergrande has a liability to asset ratio of 81%. It has a cash to short-term debt ratio of 0.36. So all these factors, and we estimate that there are at least another 10 to 15 Chinese real estate companies that are in stress, and we already had 3 Chinese real estate companies officially default on their dollar bond payments, which we think will be an ongoing theme in 22. And that really, given that real estate sector occupies about 15% of the Chinese economy, we think that China will grow well below trend. We think the government officials PBOCs already cut rates. We think there could be another fiscal stimulus of about 1.5% of GDP that will support and ensure that a hard landing is avoided, but definitely a much weaker growth trend going forward. We also see, ongoing lockdowns that are being imposed in China. China has a zero COVID strategy that has a huge hit on growth, and also the fact that they're moving towards a common prosperity drive. So they're trying to clamp down on technology, on the private sector in particular. So all these factors make us believe that China will grow at a much weaker pace. India, which I'll come into a bit more detail a little later, we actually are kept up rate of growth. We think that the recovery is taking hold. There are strong structural supports in place. There could be a short-term hit from Omicron, but post that there will be a more pronounced recovery that will take place. So overall, for 2022, the way we would view it is growth is slowing from the really sharp pace that we saw in 21. But if you look at a lot of the advanced economies, US, Eurozone, UK, even Japan for that matter, all these economies are growing much above their trend level. US growth trend level is 2%, Eurozone growth trend level is 1.6%. So all these economies are basically growing much above the trend level. So even though the pace of growth is slowing, it does not warrant any concern at this point in time going forward. While the pace of growth might be slowing, but it's still above the overall trend level. Another emerging theme, and this is going to gain traction going into 22-23, is the fact that inflation will remain fairly elevated, right? So we have plotted what is referred to as the global inflation surprise index. Positive surprise or an upside surprise means that the index is positive, and a negative surprise means it's negative. So it shows you it is at a record high. This is since the inception of this index since 2001. It is at a record high. I don't think that this kind of positive surprises has really been seen. A lot of the rise that we saw in 21 was related to temporary factors, such as supply side disruptions, supply chain disruptions because of the lockdowns that were imposed in EM Asia in particular, right? There were huge supply chain disruptions that were in place. There was a reopening trade, so services inflation spiked up quite sharply. So all these factors contributed. There were soft, weak base effects from carrying forward from 2020, where inflation rates fell quite sharply in US and Europe in particular. But going into 2022, we think that, headline inflation rates might moderate, but it will still remain above the central bank target level. So the central banks, both the Fed and the ECB, have a 2 or 2.1% kind of inflation target levels. Both will remain above that. We are actually a little more concerned about US inflation in the longer term than European inflation. US inflation, we think, will remain above the Fed's target level. And that, in a sense, will ensure that the Fed move towards tightening of policy. So inflation risks, inflation concerns remain in place. The issue for in 2022 is that if you have continued lockdowns that get imposed, particularly in Asia, then the supply chain disruptions and so on, then we could see another spike up. So that is something we're monitoring very carefully. But overall, a much higher inflation trend during the pandemic. I don't know if we ever come out with a post-pandemic, but during the pandemic than the pre-pandemic. So that is something for global central banks to think of. The only respite is the fact that commodity prices trajectory could be slightly flatter than what we saw in 2022. In 2021, there was a sharp rise in crude prices. A lot of that had to do with the fact that demand was much above overall supply, right? This was really because OPEC has curtailed supply. Compliance has remained fairly low. So demand supply imbalances persisted. But going into 2022, OPEC has given a guidance that it will adjust supply back to the pre-pandemic levels, and demand will anyway normalize back to the pre-pandemic levels. So demand supply balances should normalize in theory towards the end of this year. But in the interim period, we think there is a sharp upside. We think actually a move to 90, 95 in first half of 22 is possible. But then we see it correcting back to $75 to $80 per barrel in the second half of 2022. So I think overall, it's slightly flatter. Year-on-year increase is much more modest. As far as industrial commodities are concerned, industrial base metal prices, we find base metal prices to be more a function of China's growth prospects. China is the main consumer of global industrial metals, accounting for around 50 to 60% of global industrial metals. Given the weakening trend that we see in China, we think that historically there has always been a 12-month lag between China's growth, particularly credit offtake in China, to commodity prices. So a flatter trajectory might provide some relief, but given the kind of demand pickup that we have seen, inflation will still remain above central bank target levels. What does that mean for global monetary policy? The most important thing of all, we think that global monetary policy normalization will accelerate in 2022. We think that the Fed has already signaled that it will end QE by March 22. It will hike rates by 75 basis points. This is the guidance it provided in its last policy meeting. We actually think the Fed will end QE by March. It could embark on a rate hiking cycle in March itself. We see a cumulative 100 basis point hike in 22 and a further 175 basis point hike over 23-24. And we see the QT will commence in second half of 2022 itself. So overall, we see a fairly hawkish trend from the Federal Reserve. We see a substantial rate hikes that can get delivered over this period. And that will obviously get reflected in the currency markets. We think that ECB will keep a balance sheet expansion in place in 2020. The pace of purchases will slow, but balance sheet expansion will remain. No rate hikes are likely in 22. ECB could embark on rate hikes in 23. Bank of England will hike rates by 75 to 100 basis points over 22 and embark on QT in second half of 2022. Bank of Japan is on a perpetual state of monetary accommodation, which we think will remain in place. China has seen, China is going through its own sort of woes, economic troubles. So we actually think China's monetary policy will decouple from the rest of the world. We see China cutting the RRR and the policy rate cuts of about 25-50 basis points are likely, and continued liquidity injection. Other central banks are not going into too much detail. Australia, Brazil, Russia, South Korea, New Zealand are going to accelerate the tightening that they initiated in 2021. So overall, the monetary environment remains, global monetary policy cycle will reverse quite sharply. What does it mean for exchange rates? We think we are bullish on the dollar. We're comfortable with our bullish view for the dollar. Monetary tightening by the FOMC will work as a main trigger. Once the last time the Fed did QT, which is referred to as quantitative tightening. So as everyone would know, the Fed has purchased a huge amount of bonds and holds that in its balance sheet, right? Now, these bonds are at different maturities and they typically, they come up for redemption. What the Fed does, it has two options. One is it can buy that bond. So if there's a $100 billion bond that is due for maturity, it can buy that same quantum and make sure the balance sheet size remains unchanged, or it could let that maturity run off completely off its balance sheet. So that means that there is a net reduction in liquidity. So we think that the Fed will move forward with QT. The last time they did this in 2018, there was a sharp broad-based dollar rally that was seen. So overall, we think that will also remain in place. We have an upside view for DXY, we see it going to 99 by the end of this year. Euro is, we have a bearish trend for 22, but 23, that trend could reverse if the ECB tightens policy. But for 22, we have a bearish trend. Market is currently overpricing in rate hikes from the ECB, and that will probably have to get corrected in the middle of this year. Pound, we think that because Bank of England is also tightening policy, we think that they could actually pound will actually rally a bit, see some support rallying a little bit to 1.42 by the end of this year. JPY, we think there will be persistent depreciation. There will be monetary divergence that will push it to 118 by the end of this year. CNY, even though growth is very weak, the balance of payments are very favorable in China. It has a very large current account surplus. That is because of a trade surplus. It's also because to do with the fact that tourism outflows have dropped sharply since the pandemic. And China is opening up its bond market. There is a huge structural inflow into the bond market. Global central banks are diversifying into Chinese bonds and assets. So there is very limited depreciation actually. So we see a very flat range for the dollar CNY moving in sync with the broad dollar trend that we see in the global markets. So that's basically our global markets view, global economy markets view. Coming into India, just a quick take. So firstly, the government has estimated that growth will be about 9.2%. A lot of the demand side recovery has come from exports. During the pandemic, we've become more of an export-driven economy, which is contrary to what we've seen previously, and a huge amount of government support. Private consumption growth is still lagging behind, the recovery. That's because mobility is not really picked up to that degree, and because of the restrictions that keep coming and the different waves that we keep getting, with Delta and Omicron, that has kept private consumption fairly weak. But overall, we've seen a fairly good recovery going into fiscal year 22 relative to the pre-pandemic trend and growth that we saw in fiscal year 20. Growth has been fairly sharp and fairly spectacular in that regard. In terms of sector-wise, if you look at the sectors that are hampered the most, what we find is that your high contacts or intensive services sectors are still lagging behind the overall recovery. Manufacturing has benefited from strong exports as well as manufacturing benefits strong exports, as well as a huge restocking and huge pickup in local demand that's happened. Agriculture has been another fairly important bright spot. Government spending, which is what public services is also is important. Mining has also improved. Services really lags behind, and we think that once these waves moderate, there will be a catch up in terms of services, and that's when we will see a huge pent up surge in services related demand coming up. Within ICICI Bank, we've built something that's referred to as the ultra high frequency index. The ultra high frequency index basically summarizes high frequency indicators that gets released on a weekly basis. So we've looked at things like, for instance, mobility, Google and Apple mobility. We've looked at things like e-way bills, labor market trends, unemployment rate, participation rate, peak power demand, freight traffic, as our main variables. And what we've done is we've tried to build an index and look at how that index moves relative to the pre-COVID trend. So in January, what we've done is we've taken January, February as the average level of 100, right? We've then seen that we've seen how the sort of these indices, how these indicators move. So basically, this is not a proxy for GDP growth. This is just a proxy of how high frequency indicators are performing, a snapshot indicator. So you can see that in each subsequent wave, the net hit to growth has been much more modest. This was the first wave where there was a huge national lockdowns where the index fell much below the pre-COVID trend. Then as various phases of unlock happened, the economy recovered slowly, moved above the pre-COVID levels, but then because of the Delta variant and the lockdowns, it again fell. But the net hit was a lot more modest than what we saw during the first wave, mainly because of the hybrid models, work from home, virtual growth models, and the fact that industrial sector was less hit during the second wave than the first wave. It was all mainly high contact services that was hit in the second wave. We've again come into this third wave of the Omicron variant, and that again there has been a net hit, but overall again has been much more modest than what we've seen in response to the first or the second wave. So growth has weakened, but it's not really fallen off the cliff, and that makes us believe that growth will remain strong going forward. We've also computed statewise UFI. And what we find is that basically how this is computed is very simple. If you see reds, it means that the indicator is weakening relative to trend. If you see an amber, it means that it is neutral, growing at trend, and if you see a green, it means it's improving relative to its trend level. So you can see that we have more greens, despite this thing. We have more greens. In January, maybe there could be a slight hit going forward, but overall, not as bad as what we have seen during the previous wave. So that is an encouraging aspect from that front. As far as growth drivers are concerned, Indian exports has actually risen quite sharply and is emerging as an important driver. We think this will accelerate with the PLI schemes in place. So that's another very important insight going forward. In terms of our growth expectations, prior to the Omicron wave, we had a 9.8%, but we estimate that the overall hit could be about 0.2%. So we've lowered it to 9.6. We think that there are strong, supports in place. High infrastructure capital spending by the government will emerge as the backbone. Real estate sector revival is showing up in several areas. The PLI scheme will drive investments and export growth. And then, we also have these other investments in, EVs and renewables as well. So those will emerge as important supports. Resilient, the corporate sector is also showing some degree of resilience. Corporate balance sheets have improved quite sharply and quite considerably over the years. So, there is investment uptick that could happen once we come out of these waves. So that's another support. Exports, given the strong growth that we see in US and Europe, exports, US, Europe, and Middle East, exports will remain as a very critical driver. And of course, IT sector benefits quite sharply during this pandemic phase where we're moving to a virtual model. So we actually see pace of growth remaining fairly strong. After 9.6% growth, we see 8.2% growth. Services are likely to play catch up in fiscal year 23, given that they have lagged the recovery so far. Industrial growth moderates a little bit, but still fairly spectacular. And agricultural growth, we've assumed at trend level. So overall, a fairly robust and strong growth picture is what we really anticipate. On the inflation front, December inflation has ticked up. It's within the 4 to 6% band of the RBI, but there are huge inflationary impulses in place. Firstly, we have an adverse base. Secondly, we have a huge pickup in terms of WPI inflation, input price inflation, that has so far not really showing up in the CPI index, which we think will happen with a lag. We think that inflation will remain fairly high and a little more persistent, and that will force the RBI's hand. The RBI has already moved to what we refer to as stealth tightening, where they have actually increased the VRR's quantum, right? And that has raised the overnight rates in the local market. We think that, given that the Fed is due to tighten, given that inflation impact is inflationary concerns could persist, and given that the hit to growth from Omicron is definitely there, but is not as severe as the Delta variant or the first lockdown that we had in 2020 and 21. We think that the RBI will move forward in terms of normalizing policy. We see a 20 basis point hike in the reverse repo, and a possible repo rate hike from August onwards, either August or October. That will keep the 10-year fairly elevated going forward. So we see yields going higher, RBI moving towards normalizing policy and tightening policy in response to inflation concerns. And as we are coming out of even though we have short blips in terms of the different waves, and this is probably something that could persist for a year or 2 years, but the fact is that the economy is still holding up relative to what we've seen previously. So that is an encouraging aspect. In terms of our balance of payments and our exchange rate view, we see a balance of payments surplus actually falling. 21, we saw an unusual year for India, where the current account shifted to surplus, primarily reflecting the sharp fall in imports that took place and fall in oil prices. Those trends have reversed in fiscal year 22 so far. Imports have picked up quite sharply, reflecting a broad-based pickup across all categories. Non-oil imports have picked up fairly high, sharply. Elevated oil prices have pushed oil prices higher, and there has been a normalization in jewelry demand. So gold imports have also picked up. Going into fiscal year 23, we think the current account deficit will widen further, really driven by widening in the trade deficit to 220 billion from 195 billion. And that means, with the widening current account deficit, we think that portfolio investments will remain fairly flat and modest. We've assumed a 15 billion portfolio investment, but 10 billion of that comes from the possibility of Indian bonds getting included into a global bond emerging market indices, which could happen later in the year. But even with that, if you look at the overall trend, capital flows will be much lower than what we've seen in previous years. And given the size of the current account, it means that we'll have a much lower balance of payments. Given the global dollar uptrend that we have, where we think that it will remain fairly, we are bullish on the dollar. We think there is an upside bias to USD INR. We see it going to 76.50 by first half, that is by September 2022, and 77.50 by March 22, and by December 22 and March 23. We see Euro INR trading, actually GBP INR, we think there is more upside. Euro INR, we think is a slightly flat trajectory. So overall, story of depreciation, but the kind of runaway depreciation we saw in 2013 and 18 is not likely, given the kind of improvements that we have seen, in terms of our external position. Current account deficit to GDP ratio still fairly is not as adverse as what we saw during then. Inflation is still moderate. India is seen as a high growth destination, which will keep FDI flows coming in. Banking capital will also come in, external loans will also come in. So all these factors, there are offsets in place. Foreign exchange reserves are much higher relative to what we were then. So the 2013-2018 kind of depreciation is unlikely to take place, but definitely there is a depreciation bias that we think will remain. So yeah, so that's it from me. Main message is our growth is the global economy is recovering. Headline growth will be lower, but still above trend pace. We'll see that even in India, growth will be fairly strong. The net hit from Omicron has been a lot more modest than the previous waves, which we think will continue. Global monetary policy normalization will accelerate, particularly the Federal Reserve, given the sharp increase in US inflation rates. That will mean that there will be a broad-based dollar uptrend that could persist in 22. Only if Eurozone inflation surprises to the upside will that really reverse. As far as India is concerned, we're fairly strong and we're fairly comfortable in terms of saying that growth will be fairly robust. RBI might start normalizing policy from April onwards, and there will be a gradual monetary policy normalization and rate hiking that will happen. Rupee, dollar, INR, the bias is to the upside, given that current account remains elevated and capital flows could be much more moderate than what we've seen in previous years. So yeah, those are the main messages from my side. Yeah, thank you. I'll hand it over to my colleague Arpan. Thank you.
Thank you, Mr. Chakravarti. Thank you, Mr. Chakravarti, for making us prepare with the current global as well as Indian outlook of the economy and much needed deliberations on the growth forecast on monetary policies and foreign exchange outlook vis-a-vis rupees. With these, we would be more excited to learn the nitty-gritties of hedging foreign currency. To give the presentation, we have with us Mr. Abhishek Gaur from National Stock Exchange. Dear participants, I would like to brief you all about Mr. Abhishek Gaur. He's associated with National Stock Exchange of India Limited for the last 7 years. He is designated as Senior Manager handling Business Development Portfolio for Southern Region. He's an MBA Finance from ICFA University. He has been working in financial market space for 15 years. Abhishek ji has rich experience in various verticals of capital market, business development, index, stock derivatives, forex, and interest rate risk management, fixed income markets, mutual funds, trading technology, and listing of small medium enterprises. I welcome you to take the session on hedging forex risk. Abhishek, sir.
Thank you, Lokeshji. Thank you for that introduction. First of all, I would like to express my gratitude to the President of FTCCI, Mr. Bhaskar Reddy, and his team, Mr. Agarwal, and Mr. Dev, and the entire team, along with Mr. Khyati Narwane and Kulkarni ji and Lokesh ji for organizing this session. Though yes, I've got a lot of support in terms of organizing these type of sessions with FTCCI in the help of Mr. K.K. Maheshwari and Vim Kankareji. I also thank them for their continued support. Am I audible? Can you just confirm me, Lokesh?
Yes.
Yeah, thank you. So today's session, I would be basically talking on how we as an enterprise can look forward to use the foreign exchange market to optimize our business. This basically looking at a scenario or a product which would basically help us in protecting our benchmark. See, in this current global economy, which we have been talking about for a few minutes now, globally, when we look at, there is a lot of fluctuation in terms of growth and in terms of how the economies are placing themselves to be the front runners to the preceding entities. So in this kind of a scenario, if we don't have proper businesses and policies and practices in place, we definitely would lag behind between our peers within the country. And subsequently, if it is not practiced at a larger end, then definitely it would impact the entire economy as such. Yeah. So probably if we are there into a global economy, foreign exchange is, yes, one of the important aspects to be looked at, which was, though, yes, not very predominantly looked at as a segment a very, very long time back. But now people have started getting into it. People have started understanding the importance of it, because it basically helps them in protecting the benchmark, and benchmark price is always required to be protected, because that would help the enterprises in terms of projecting, probably keeping their projections in place in terms of how their cash flows are placing out. So if we look at the current scenario in India, we are having two markets, or probably two platforms where corporates and businesses who are having an exposure into foreign exchange can basically come and use the facilities of the platforms and do it, which is basically the OTC market. And then subsequently, we have the exchange market. Exchange market was actually open for the participants in 2008, but has started getting a bit of traction probably 4-5 years later, when corporates have started actively looking into it, and with the new regulations of RBI, it again slipped for a bit in the middle, and then again now it's decently up. If we look at the way we have grown, or probably participants have been using this platform on the exchange, on an average daily turnover, it was somewhere around 14,200 odd crores in 2011, which is currently around 26,500 odd crores in 2021. So this is how the participants have taken up this platform on the exchange for hedging their risk of currency, and then subsequently benefiting out of protecting their benchmark and meeting their targets in terms of how they are projecting their businesses. So just allow me to share my screen so that we can get detailed into what we'll be discussing. So today we'll be covering things like what are the currency pairs available on the exchange in the Indian market, how the trading happens on the exchange system, how the settlement happens, how you can manage your risk, and subsequently who are the participants. So if we look at this chart, we generally can understand there is a lot of fluctuations in this trend line, which is visible. So if we try to plot our business on this line, and unfortunately, if we are there on the reverse side of the trend, then definitely the inflows which would be impacted. Why? Because if say somebody is an importer, imported at say 74 rupees, and currently if he's bound to pay 74.5, which would be the current exchange rate available, then he'll have to shell out 50 paise more. So the trend line is always constantly moving, and in this dynamic market, we need to always think that if we are not able to protect our benchmark, then definitely we would be ending up making negative cash flows and would be impacting our business. One thing before I start the entire presentation, I would like to tell all the participants who might be having different myths about foreign exchange hedging is that if you are doing hedging in a proper way, or probably if you are doing hedging in the true spirit, then there is no loss which you would be incurring in the business. Why? Because it's a protection of your entire benchmark which you will be doing, or probably invoicing price, if you can easily understand. So if hedging is done properly and you are able to see that your payments and your receivables are matching as per the foreign exchange, be it whichever platform you are doing, be it on the exchange or on the OTC market, if you are doing it ethically and properly, definitely you will not be able to end up making a loss into your business. So that is one point which everybody as an enterprise need to know, and they need to meticulously follow this, because if they don't, then the repercussions would be hazardous. So in current scheme of things, as I told you, we started in 2008 on the exchange. We are having two types of currency pairs. One is future currency to Indian pair, which is generally and popularly known, which is called USD INR kind of jargon, where USD would be the base currency and INR would be the quote currency. And similarly, we have Euro INR, Great Britain Pound INR, and Japanese Yen INR as contracts available on the exchange system in India for participants to hedge their foreign exchanges. Subsequently, recently, we have also launched cross currencies for those kind of entities who are having exposure into different markets. Say somebody is importing from Euro and exporting to US, where they have an exposure to both the countries. And if they want to protect that as a benchmark, then definitely they can use this cross currency pairs for managing their currency risk. How does this happen? It happens on a screen-based trading platform where the market's prices are clearly dynamic and would be same across the entire country at a given point of time. It gives a lot of transparency in that sense because it's a screen-based platform. It's an anonymous order-driven platform where the counterparty would be a definite participant in the market, or transactions would be matched on a price time parity basis. It's an inbuilt risk management. Depending on how the margins and MTMs are available, systems would accordingly do the trades and help corporates entering into a transaction. Multiple connectivity options are there. So if you look at these days, we are talking about digitization across the globe, but the exchange market has been digitized way back in around 25 years back. So we have connectivity options in terms of a desktop or a mobile or probably any kind of a portable instrument which people can carry very handy. There are multiple trading platforms, and market information definitely is accessible to people because of the reach of digitization and technology in the current space. So this is how people can look at use these platforms for managing their currency risk. So in terms of what kind of contracts which we have on the exchange, we start have the exchange basically is a standardized market, to be very precise. We have a set of rules and regulations which drive the entire contract and how the settlements happen, how margining is taken place, and how the contracts are settled. Each and everything is a written document and is credit agnostic. It is similar to all the type of participants, whether be it a large company or a small company, or come what may, everybody has to follow these kind of rules. So it's basically a democratized kind of a system where foreign exchange happens or any kind of trading happens on the futures and option platform of the exchange. So in terms of that, if you look at on the exchange, the USD INR pairs, we are having contracts starting from 1000 USD. So people can hedge those contracts in multiples of $1,000, and also the lowest of $1,000 can also be, this is what I want to basically put it forward. So it makes a lot of it basically helps smaller corporates or small businessmen who use this platform and definitely help benefit from the foreign exchange hedging. Similarly, for Euro and GBP, we have 1000 units as the contract of that respective currency, and similarly for JPY, it is $1 lakh. So Euro, the cross currencies, I'll basically not be getting detailed into cross currency because it is only subjective to a few participants. Largely, it is the FCY INR pairs in the entire presentation, which I would be basically focused. If somebody is having a specific query, then we can discuss on the cross currencies specifically during the question and answer session. In terms of what type of contracts we have futures, which are 12 serial monthly contracts. So right away we are standing in January. The January end would be the last working day of the banking system, minus 2 days would be the expiry on the exchange platform. That would be on that day, 12:30 p.m. would be the last transaction which would take place on the current month contract. Subsequently, the next month contract would be live from 12:31. So this is how the exchange platform works, and it would be spanning for over around 12 months. So if we are there in January till December 2022, we have contracts which are available for participants to hedge their currency risk. Similarly, we have another tool which is more dynamic, which is more useful for a few set of participants, which is basically options. So options are easy on the exchange platform. It is a standardized mechanism. There can be different type of structures which a treasury desk at a corporate can build, or for a importer, it definitely gives a lot of benefit because you can hedge your exposure at a relatively lower cost. So there are a few tools which people can use on the exchange platform. And on the option side, we have 3 serial monthly contracts, and there are quarterly contracts which are available for the another 3 quarters left out for the year. In terms of transaction point, we do a transaction on the exchange in terms of 4 decimals. That is, after point, that is paise, we do it in 4 decimals. That's a quarter of a paise transaction happening on the exchange platform, which actually helps the corporates of the participants to recover a lot of their operating cost. So the impact cost of doing hedging or the hedging cost also can be easily met, and the transactions can happen pretty seamlessly on the currency platform of the exchanges. In terms of market timings, when it is available, how people can do it, it starts from 9 a.m. in the morning and ends at 5 p.m. in the evening. So any participant who is interested in hedging in USD INR or a Euro INR or a GBP INR kind of a contract, they can start from 9 a.m. in the morning till 5 p.m. in the evening. Whereas on the cross currencies, we are having market timings which are open up till 7:30 in the evening. So this gives a lot of leverage for the participants to also look at this as a platform where the current system which is not available because the other markets have their times. If somebody wants to do it after that also, they can try to use this platform for hedging or protecting the overnight risk also. So these are few ways which you can use this market very diligently and very protectively. In times of settlement, we are having 2 type of settlement. One is a daily settlement and another is a final settlement. Daily settlement is basically as per the daily settlement price of fluctuations in day to day, beginning to day end. Whatever price is there, that is basically net off, and that would be the basically half hours weighted average price which would be available for participants for the exchange to determine what would be the daily settlement price for a contract which is open with the importer or an exporter. Similarly, on the final settlement, if somebody is closing it as per the exchange settlement days, then it would be settled on the last working day of the banking system. But though the contract is expiring 2 days prior, the holder needs to hold it for the next 2 periods, and they'll have to hedge it accordingly. Probably settle it according to the RBI's reference rate on the last working day of the banking system. And these are cash settled contracts. It is not a delivery which would be happening in the foreign currency. So if we understand it with a few illustrations, as an importer, if say somebody is having $100,000 as an exposure, what he needs to do and how does he get into it? What are the requirements if we look at and how we would be able to protect his benchmark is the illustration which would be running about. So here, if say somebody is hedging at 75 rupees 50 paisa for say 100 contracts, because it is a $1,000 contract, and $100,000 is again 100 multiplied by 1,000 is $1 lakh. So 100 contracts are to be hedged on the exchange. So the margin money, which is a security deposit, which would be at max would be 3%. So then generally it is based upon the span profile, span margin which is applicable. So generally it comes 2.5 to 3%. This is what the range is. But yes, if you look at $100,000, then it is 2,26,000 rupees, which would be required to be posted as a security margin, which would be refunded to the participant when the contract is closed. Here on the exchange platform, there is no hard and fast rule of cancel and rebooking. You can rebook the same contract when you feel that you are in a favor and if you don't want to hedge it further. So cancellation and rebooking are possible on the exchange platform. If we look at the scenario where the remittance is received or expected to receive on the month end, on that time, if the currency has increased as an exporter, definitely he would be looking at benefiting the currency movement. But as he has hedged in the exchange system, currently what we call as booking a forward in an OTC market, here we call it as doing in the future. So here somebody is writing a future or selling a future. In that scenario, the participant has sold at 75.50 and again has to buy back at 76.50, this would be 1 rupee negative cash flow on the exchange. But again, when we look at how the conversion is happening in the OTC market, the conversion happens at 76.50 rupees. So when you do an accounting, so the mathematics basically nets off to 75.50 only. Thereby, it basically helps the corporate to log the transaction at the invoice price or probably the benchmark price. This is the beauty of a futures platform, a futures contract. And similarly, if it goes the other way around. So if we find that the currency is going negative and it is on the settlement date is 74.50, then the exporter has sold it at 75.5. Conversion would be happening at 74.5. As the conversion in the OTC market is happening at a lower price to the benchmark, but the same transaction is hedged on the exchange platform, the cash flow would be positive and the net of mathematics again would be ending up at 75.50 rupees. So by doing a hedging on the futures contract, the participant is basically locking the transaction and he can basically take a relief. He can be relieved from the tensions of currency movement and he can do his business as per the general course of activities. So this is how the futures contract would be helpful for participants by locking the contract. So similarly would be the reverse situation for an importer. So in case of an importer, if the payment is to be done at a higher price, then he would be at risk. But if he does hedging or buys the futures contract at the particular price, then he can basically have a sound sleep stating that wherever the currency be there, whenever his payment is there, the impact on the cash book would not be there. So that is how it would be definitely useful. Similarly, if we look at options. Options are basically to be understood. I'm telling it's not exactly what we are going to talk, but to make all the participants understand pretty easily, I'm trying to correlate it with this example. Say if we are taking in insurance, what does we do in insurance? In a general insurance, we basically pay a premium and try to see that we are protected for an unforeseen instance. So here, what would be an unforeseen instance for a business as an importer? If the currency is the Indian currency is depreciating and the foreign currency is appreciating, correct? So in this scenario, if somebody is an importer and he has logged a benchmark price for importing some commodity, and if the currency is moving over and above to that price, or probably Indian rupee is depreciating after the time he has entered into that transaction with the counterparty abroad. So in that situation, what would happen? He would pay a small amount of premium, where he would not be required to pay an amount of premium the way margin is to be deposited in a futures contract. It will be a fraction of that. So in that scenario, a small premium is paid. He would be covered for the entire contract. And if in case there is a impact, there is a damage which is done, then definitely the exchange pays back him. If there is no damage, then the premium which is paid goes for basically that premium expires, and that is a kind of an expenditure on the books of the importer or an exporter. So if we take importer as an example, say somebody has identified 75.50 as the benchmark for importing a particular commodity, for same $100,000, the total premium which would be paid is, say if it is quoting at 40 paisa per dollar, then 40,000 rupees is what in total he'll be paying. Whereas on the futures, they will be required to give a security deposit which was refundable. But here there is no refund of premium which will be happening. Here there would be a 40,000 rupees premium which the importer needs to pay. Similarly, that would be an example for exporter also. On the expiry, if we say that the currency is ending up at 77, then 2.5 rupees what he will be required to pay from his pocket if the hedging is not done. Here on the exchange platform, as the importer is hedged it, he would get that difference from the exchange, 1.5 rupee, I'm sorry. So he'll get that difference from the exchange, and the real payment on the real payment to his counterpart from the banking system would happen at 77. So he's again relieved from his tensions of currency movement. Similarly, if it comes down to 72.5, then he need not pay at 72.5. He will basically, the expenditure would be only 40,000 rupees, which is a premium. And whatever lower amount which is getting is basically an advantage for him in the terms of currency fluctuation. So this is how futures and options help participants in managing their currency risk. And in terms of how things would happen over here, if you look at, we basically take margins, the net off I told it was around 3%, but these are the breakups which are available over here. Similarly, if somebody is doing a calendar month contract, then the margins are relatively less, and that can be basically looked at. That is selling this month's contract and buying next month, or probably vice versa if somebody is having a relative exposure. And one thing which is there are myth in the market that many people say that I have both import and export and I have a natural hedge. Yes, prima facie you would be having a natural hedge, but when you do a payment, that day it is not a natural hedge. And in the last 3-4 months, if we have seen, there has been a movement of 1.5 rupee in terms of USD INR prices on both sides, be it an importer or an exporter. If somebody has not hedged, they have basically faced the heat of currency movement, even if somebody was a natural hedge in terms of both import and export as a exposure. So I advise people to look at it seriously and look apple for apple instead of clubbing two different things in the same scenario, because your payments and your receivables don't match all the time. So look at it very diligently and start implementing it with a proper risk management policy. Don't do it haphazardly. Okay. How people can pay margin to the exchange? They can do it in the form of cash deposits to the exchange by giving check or probably anything to a broker. Or else if somebody is already invested in some securities like liquid funds or probably any sovereign instrument in terms of treasury bills or government securities, they can definitely give those as collaterals so that their margin deposit, which is required to be hedged on the exchange, can be taken care of. Yes, the premium which they'll have to pay it in cash only. And other collaterals like equity shares, if somebody is listed entity, then they can also use those shares as collateral, which can act as a security deposit. Or somebody is already investing in equities as an entity, also they can use the shares as margin, pledge it to the stockbroker and do the hedging activity very diligently. What type of participants are there? In the exchange market, it is a very broad-based mechanism, broad-based participants, because all type of participants, be it a hedger, trader, or an arbitrager kind of an activity, players are very active. In terms of specific type of participants, banks are participants on the exchange, stockbrokers, trading members of the stock exchange, corporates, be it importer or an exporter, they do it. FPIs, foreign portfolio investors who are having an exposure to the Indian market, they do it. NRIs have been recently allowed to do, and subsequently retail participants, because it's an exchange platform, there is a retail participant who has a view on the currency can also participate on the exchange system. This basically increases a lot of depth. That is how I was talking about the average daily turnovers rising from 14,000 crores to 26,000 crores on an average basis from 2011 to 2021. So this is how the growth has been, and a lot of participants have been added to the system in that way. One of the beauty of probably one of the best facility which is accessible to smaller participants or probably a kind of an entity is that on the exchange system, up till an exposure of $100 million, people or participant don't need to provide any underlying proof for hedging their currency risk. Over and above $100 million can also be hedged. So there is no restriction that a bigger company cannot do it. But yes, up till $100 million, as you do not provide any underlying proof, your decision making and your hedging activity becomes a more fast because of small, simple KYC norms on the exchange system. It basically helps a lot of corporates in managing their currency risk very, very diligently and very suitably. Generally, what are the factors impacting the currency price? Anyways, Mr. Shivam has already discussed in detail about how the currency fluctuations would be happening, but these are a few points where participants can take a note. Basically, it's the GDP growth would be impacting, inflation rates would be impacting, interest rate scenario impacts retail sales, numbers impact, IIP data impact, and subsequently the unemployment rate in the country also impacts a great deal. If we look at this scenario where in the last 1.5 year, we have been moving from an import-oriented economy towards export-oriented economy, it becomes very, very important because Indian currency is mostly on the depreciating side, but we never know how the global scenario and the geopolitical issues pan out. And if any exporter is there, if he is not able to properly hedge their exposure, then instead of being benefiting from the currency fluctuation, they'll be able to currency movement, they'll be able to end up themselves in making losses in the currency exchange rate. These are few recent developments to take a note of before I end my presentation. FIs and NRIs have recently been allowed, so they can do it. We have also introduced options on non-USD INR pairs. There are weekly futures and weekly options also available for small participants. Anyways, this is not for corporate, but these are developments how the segment has evolved. This is only a symbol of how the segments have evolved, where participants have been flocking to this platform and doing their hedging activity pretty seamlessly. Benefits would be, yes, there's a lot of transparency on pricing. Low impact cost is there. As I told you, it's a credit agnostic platform. Direct access is there to the participant. They can look at the prices and decide what time to hedge. And subsequently, they are also associated and helped by a lot of advisors. If they seek to take support, then they'll be able to make decisions wisely. Higher flexibility, as I told you, there's a facility of cancel and rebook on the exchange platform that can be used. Extended market hours are there. And structured deals, as I told you, options are available. Somebody wants to do a structured deal in terms of making their hedging cost favorable, they can use those also. This is how our trading platform looks, and this is what I was talking about, 4 decimal points. So this is the snapshot which is available for participants to take a note of, and they can use this platform for their hedging on the currency. Small growth numbers. So basically, these are the only points which I wanted to cover. The simple flow, how people can get onto the platform is select a stockbroker, do the normal KYC, post your margins. As I told you, there are multiple ways of providing margin, and then subsequently you are ready to do your hedging activity, and then we can do a currency risk very diligently and very actively on this platform. Before I conclude, I would definitely make a point and try to urge all of you, if you are not doing any hedging in this scenario of the economic growth, I would urge all of you to kindly look at it very, very seriously. Come what may platform you are reading, but don't keep your exposure unhedged, because unhedged exposure is always sitting on a time bomb, and you never know how the currency fluctuation would impact your books. And there are many big corporates who have not done this, has ended up making lots of loss in their balance sheets. So come onto the platform, be it on the exchange side or on the OTC market, talk to your financial advisor, talk to us, talk to the banker, and definitely take a hedging call and try to make a policy before you get into it, because this is a kind of an animal which somebody doesn't understand, you would definitely be misguided. So have a policy in place, follow your risk management policy, and do your hedging activity. With this, I would basically conclude my remarks and hand it over to Mr. Lokesh for further words. Thank you.
Thank you very much, Mr. Abhishek, for such a knowledgeable session. After learning the various perspectives of hedging the forex risk from the stock exchange point of view through Mr. Gaur, now we would like to make our participants aware of the banker's outlook on the hedging forex risk to have more holistic purview. To enlighten us on the subject, we have with us Mr. Arpan Jain. He's a banker with an experience of over 15 years, including bank treasury experience of 14 years. He has been working with ICICI Bank for the last 2 years and previously worked in HDFC Bank. Currently working as regional head treasury for rest of Maharashtra and Goa, Madhya Pradesh region. I request Mr. Jain to take the session ahead for the benefit of all. So please.
Thank you, Lokesh. Thanks, everyone. I'll just share my screen. So what Mr. Abhishek has covered is the way you can hedge your exposure by way of NSE platform, wherein you have currency future as one of the options and all. And now I'm taking you through the products you can use to hedge your exposure with the banks and all. I hope the screen is visible now.
Your screen is visible, sir.
Yeah. So typically, a company has two options. One, they can hedge the exposure with the banks so that whenever the underlying transaction happen, they can utilize the same hedging instrument and make the payment or receive the payment by utilizing that particular deal which you have booked with the bank. Second option is what Mr. Abhishek has taken us through on the on the platform, which is not on the OTC platform, but it is on the exchanges. So I'm taking you through what typically the clients are doing. We'll try to skip some of the part which Mr. Abhishek has already covered. So the major question is why to hedge. See, as an exporter, if you are budgeting a particular rate for your export receivable, and if the market moves adverse to your position, then you can have a loss. And on the contrary, in case of an importer, if he is budgeting a particular rate for his import and the rupee depreciates against USD or any other currency, then probably you may have a loss in your position. And that's why it's required that you take a calculated call on when to hedge, how much to hedge, and how to hedge. So if you just look at the dollar rupee chart for last say 1.5 year or so, we had seen bouts of depreciations and appreciation happening at a different time zone. Especially if you just look at the last year COVID, sorry, last year COVID time moment or so, we had seen a sharp depreciation in dollar rupee level, and which was followed by a sharp appreciation. So in times of these type of volatilities also, you may end up with a loss if we are not adequately hedged against our exposures. And that's what we should try to look at, what kind of hedging policy you should use as an entity, and how we can maybe modify some of the hedging strategies to suit that particular company's requirement. So dollar rupee chart, if we had seen similar movement in euro as well as GBP also. So I'm just rushing through this particular charts and all. Now, what are the tools of hedging? Typically, there are only three tools which you can ideally use as far as a company is concerned. What kind of strategy you can use? You can book 100% of your exposure by way of forward. You can use options, or you can even choose to keep your positions open. That means you are not doing any hedging of your exposure, and you feel that the market will be in your favor, and you will be able to kind of sail through with your hedging strategy. Or the second or the fourth option would be a mix of three. You can maybe keep some proportion of your exposure open. You can cover part of the exposure by way of a forward, or you can cover the same by way of options also to some extent. Now all these strategies are there, and different companies employ different type of strategy at various point in time. So for example, today dollar rupee is trading at around 74 half level or so. In case if the level goes to say 76 or 76 half, as an exporter, you have two options. One, you can book a plain vanilla forward, lock in your receivables at a particular rate. So, for example, for 3 months, if you're receiving a premium of 1 rupee, spot is 76, you will be getting a forward rate of 77 rupees. You can lock in your forward at 77 and just forget. But what if you are expecting the dollar rupee to move even further? In that particular kind of scenario, it works well if you are taking your hedges by way of an option. Because what happens, options gives you a chance to participate in any kind of rupee depreciation. So if we take a different example, in case of option, today dollar rupee is say 74 half. We are expecting that as an entity, if we are expecting that rupee will depreciate further because Fed is likely to tighten its monetary policy in coming months or so, you may want to take a call that instead of you hedging by way of forward, so for example, if you are hedging for 3 months At 74 half, you may be getting a premium of say 75 half levels or so. So you have two options. Either you book a forward and take a rate of 75 half. If you are of a strong view that the rupee is going to depreciate even further and you are expecting rupee to maybe go to 76 or 76 half in next couple of months or so, you can look to hedge by way of an option, so that in case rupee depreciate, you are able to participate in the rupee depreciation. And third option is you can even keep some of the positions open. If you are having a strong view that rupee is going to depreciate and move in your favor as an exporter, you can keep your positions open and you can take a call on hedging that particular exposure. Maybe after few weeks or few months, depending on when your actual payment is due. I mean, receivable is due. So these are the general strategy which are generally used in the Indian market. Now, if you just understand the timeline and all, so if you are booking a rate for value today it's 19th of Jan. If you are booking a rate for maturity today, you have a export receivable or you have an import payable today, and you are covering the rate for making payment today, it's called a cash rate. If you are covering any rate for which is due tomorrow, which is 20th of Jan, which is a working day, then it will be called as TOM rate. If it is T plus 2, means cash plus 2 days, it is called a spot rate, and any tenor beyond that particular spot date will be called as forward date. Now, if we just take an example of an exporter, how the exporter's payoff looks like. Right now, the spot is at say 73, 3-month forward rate, you are getting at 74. It's basically, you are getting 1 rupee premium for hedging your export receivable. This chart shows that if you book a forward at 74 rate, if the rupee depreciate beyond 74, you will not get any participation beyond 74. And ultimately, in case, say, for example, you take the rate on maturity, the rate becomes 74 half, then you are losing a payoff to the extent of half a rupee on every dollar you have booked, because forward is a commitment from your side as well as from the bank side that you will get the same rate on your maturity irrespective of the rate prevalent in the market. So on maturity, irrespective of whether the market is trading at 73 level, 74 half level or 77 level, you will get your receivables paid at the rate of 74 only, because you have already booked a forward contract. It's a contractual obligation between you and the bank. Bank cannot deny that particular thing, and you cannot deny your position also. In case if there is any delay in receiving your remittance or so, you can cancel and roll over that particular deal, or you can just cancel the deal and whatever profit or loss is there, you can participate in that particular thing. So forward contract, the advantage is simple instrument at the time of booking the deal. You know for sure what is the it eliminates exchange risk, because you are totally sure this is the rate at which I'm going to convert my receivables on that particular maturity date. Secondly, there is an option of you booking an option dated deal. So for example, you are not too sure whether you are going to receive the money on a particular date or so, but you are pretty sure that you are going to receive the money between 15th of say March to 31st of March. You have option of booking an option dated forward on the OTC market, which will give you an advantage that the rate will remain same for that option period, and you can utilize your forward on any of the day during that particular tenure. Now, there are RBI guidelines which govern the FX market, but RBI has eased a number of guidelines, and practically you don't require any kind of underlying document if you are booking a deal up to $10 million. Or in case of contractual exposure where you have got invoice and order copies, you can produce that to your bank as an underlying exposure, or you have one more option of booking the deal against anticipated exposure. In case if your order is not finalized, but you are pretty confident that the order will come to you in next couple of days or so, you can still book the deal basis the anticipated exposure. Now, the disadvantage is no participation in case of favorable movement in the exchange rate. We had seen in the example, if the rupee becomes 74.5, but your forward is at 74, then you cannot participate in the rupee depreciation if rupee depreciates. So you are locked in at 74. You cannot get a rate better than 74. And on the other hand, you will also not get a rate worse than 74. Say rupee remains at 73 levels only. You are already locked in your rate at 74. And why this difference between 73 74 is there is because of the forward premium. And forward premium is nothing but interest differential between the Indian currency, Indian interest rate, as well as the US interest rate. India being an emerging market, the interest rates are on a higher side. And that's why as an exporter, you get additional forward premium, and the same forward premium becomes a cost for an importer. So if you are an importer, then you would have ended up paying 1 rupee higher than what is the prevalent dollar rupee rate which is there in the market, just because India's interest rate is higher. So the forward premium, which is an extra income for an exporter, it's an additional cost for an importer. Now, if you just example we had already seen, client had booked a forward at 74, realization is locked at 74, but you will not be able to get any advantage if rupee depreciate beyond 74. You have logged in your rate at 74 only. Now, what happens in case if you don't receive the money, or you receive the money a bit in advance? I've just taken those two scenarios out here. So what if the company get the remittance earlier than maturity? So there are two options available with you. One, you can, if you are not in need of funds, then you can keep the funds in your EFC account, and you can convert the same on the maturity of the forward contract. Alternatively, you can pre-utilize your forward contract by paying the premium from the date on which you are utilizing the deal to the maturity date. So for example, if you have booked a forward contract for say 31st of March maturity, you got the money on 20th of March only. You can utilize the deal on 20th of March and make the payment of premium from which is prevalent on the market on 20th of March for maturity of 31st March. Initially, while booking the forward, we had received the forward premium till end of the maturity. But here, if you are early utilizing the deal, you are going to make the premium payment for those 10-11 days if you are utilizing the deal of 31st of March on 20th of March. So that is the one scenario. And second scenario is if the company received less. Say for example, if you booked a deal for $1 lakh and you receive only 50,000, you can part utilize 50,000. Any number of times you can part utilize your deal. It's permissible. There's no issue. Even if you receive say $1,000, you can utilize out of that $1 lakh contract. And after utilizing your part balance, whatever balance is available, you can cancel the deal. Whatever is the gain on cancellation, you can get the same on maturity. In case of loss, you need to make the payment to the bank to the tune of the loss which is incurred on the forward contract. For example, if you booked a forward contract at 74, but rupee depreciate to say 74.5, and you received only $50,000, the balance $50,000 you are going to cancel at a loss of 50 paisa per USD. I hope the example is clear. Now we move on to the options. In case of forward, I had taken an example of exporter forward. In case of option, I've just taken an example of vanilla call option. Similar, so call options give you a right to buy dollar at a future maturity at a particular rate. So for example, here we see we had bought a call option with a strike price of 75. If on maturity dollar rupee is trading beyond 75, we can still purchase the dollar at the rate of 75. If dollar is trading at a level below 75, then we will let the option exercise without exercising the option. I hope I am clear. Any queries till now?
Queries will be asked at the end, sir. You can continue.
No issues. That's totally fine. So in this particular example, if rupee is trading at any level below 75, then we are not going to exercise our option. However, if rupee depreciate beyond 75, then we are going to exercise our option, and you will purchase dollar at a rate of 75, irrespective of the market trading at 76, 77, 78 level, whatever, if rupee is trading at a level higher than 75, then we are going to exercise the option. Otherwise, we will let the option forgo. Whatever forward or whatever option premium we have paid in the beginning, that will be lost. So option comes with a cost because you need to shell out additional premium from your pocket. Whereas in case of forward, the forward premium is already inbuilt into your forward rate itself. So I'll just quickly take you through the difference between forwards and options. So forward contract cancellation is permissible. In case of options, it is also possible. In case of forward, you can take early delivery, but in case of option, you cannot take early delivery, but you can unwind the option. In India, we use European option, which can be exercised only on maturity. Before that, if you want to, we don't have an option of taking the early delivery of option. We can extend the forward contract, yes. In case of option, you need to again unwind and enter into a fresh option. There are various factors which impact your option pricing and all.
See, voice is lost.
So while taking option, you can go. Pardon? Various factors which are there. Now, in case of option, there is a strike rate, there is a maturity date, option expiry date, and there is the amount which is payable upfront. In case of forward contract, we are not paying anything upfront. Whatever rate is there, whatever cost is there, that is inbuilt into the rate. In case of option, you are paying a premium. So, for example, today, if rupee is trading at say 74, you have an export receivable after say 3 months. You can book you can take a put option of 74, 74 half, 75 half, whatever rate you want. You can take an option for that particular strike price. But the higher the strike price in case of an exporter, higher the premium you will have to shell out to enter into that kind of an option. So in limits, in case of forward contract, limits are required. Typically, the limits required is you block around 5% of your limits. Of the 5%. Sorry.
Any screen sharing you are doing or how PPT? Because we are not able to see.
Screen is not visible.
Now, just 2 minutes back only. So you are visible. So any PPT you are showing right now, that is not visible. Now it is okay. Forwards versus options.
Fine, fine. So,
yeah.
So we lost the presentation from this slide only, right?
Yes, please. Yes, yes, yes.
Okay, fine. Yeah. So in limits required, typically you in ICICI Bank you require 5% of the limit to be received in next 1 month, and for which the delivery will happen probably for after another 3-4 months or so. You can enter into a forward contract or an option contract basis anticipated exposure, which is permissible by RBI. And otherwise also RBI has given a window now that if you have an exposure up to $10 million, you can book the deal with the bank under a facility of below $10 million. Moreover, you can book forward contract against any kind of capital account transactions also. So if you have a loan liability or like a ECB, or you have taken FCNR loan or something like that, you can still book the forward or options against the same. Tenor as per underlying. If you have an underlying for 5 years, you can even book a forward contract for a 10 or 5 year also. There's no restriction on the tenor. As far as delivery date is concerned, forward can be a fixed dated, in which you will have a maturity on a one particular date, or you can have a window of maximum 30 days. So if you are expecting the money to be received anywhere from say 1st of April to 30th of April, then you can book a option dated forward contract starting from 1st of April to 30th of April, and the rate will remain same for you. In case of option, it has to be fixed date only. There's no option dated option kind of scenario in case of option. Now, as far as digital offerings of the banks are concerned, you have got iTreasury. iTreasury help you at the pre-trade, at trade, as well as the post-trade. Pre-trade gives you access to the treasury research reports, wherein you can go through the report, form your view as to where you feel the dollar rupee will be moving, or even if you have exposure into euro or GBP, even reports on those currencies are available, along with the research reports on the interest rate scenario. At the time of doing the deal, you can book a deal through the online platform offered through iTreasury. Post-trade, whatever forward you have booked, you can accept the forward confirmation through the iTreasury platform. Now, ICICI Bank has also provided online forward limit setup, wherein if you are utilizing any forward limit, which is backed by FD, then you can create a FD backed forward limit online itself. We also have a trade online platform wherein you can do all kind of trade related transactions on the trade online platform. So in case you want to open an LC, bank guarantee, you want to make an import payment, all of that can be done through the trade online platform without going to the bank or without submitting any document to the bank. Instabase is the mobile application which ICICI Bank has, wherein you can do practically most of the banking transaction, including your trade transaction, on the Instabase platform itself. These are the currencies which you can in which you can trade through ICICI Bank or hedge your exposure through ICICI Bank. You can make payment in any of the currency, which include the G7 European currencies, Middle East, even Chinese yuan. You can make the payment, or Russian ruble also if you want to make the payment. That's possible. That's it from my side. Now we are open for question in case we have any. That's it from my side. Keji, hand it over to you.
Thank you, Mr. Jain, for making the program really meaningful by your experienced deliberations and wonderful delivery. Now, I would like to open the forum for question answers. I request the participants to come forward with their questions. They can raise their hands and we'll give them the access and they can speak. We have some questions here, sir, to both of you. Like some questions have already been posted. I would like to say on behalf of Mr. Ahmed Khan, he's from the Clay Capital. He has asked this: in the case of manufacturing company seeking offshore debt, ECBs, please explain the hedge fee impact if the company has a dollar exposure and if the company doesn't have a dollar exposure. Yes, sir.
So the thing is, a company is having a ECB, and I just from the question, if correct me if I'm wrong, you mean to say that you have got some export receivables against which you want to hedge your ECB. That is one way of looking at your exposure, because in that case you will be having a natural hedge. You have a liability in foreign currency by way of ECB, and on the other hand you have export receivables, so you can use your export receivables as a natural hedge. Second option, you can enter into a currency swap, wherein you can convert your foreign currency liability into a rupee liability by way of a currency swap. Now currency swap will be you can cover your interest rate, or you can cover your principal swap also. So basically you can also hedge your LIBOR. For example, now LIBOR has been replaced with the new benchmark. So USD, in case of a USD, LIBOR is getting replaced with SOFR. So you can hedge your SOFR, or previously what we used to call LIBOR. That is one way, that you just want to hedge your LIBOR and want to keep your currency exposure open. Second option is you want to cover your interest rate liability as well as your currency exposure both. So you can do with you can hedge it completely by way of a currency swap. Currency swap we have not covered out here, because generally very few companies go for that kind of a transaction or have foreign currency borrowing for a longer tenor.
Yes. Is there any hands which have been raised? Or should I go with the next question, sir? Another question is from Mr. Pratik Sharma. Is there any difference between the price or the premium we sign from bank versus what we do from NSE?
Yeah, there's a difference. NSE is your I would say exchange platform, and banks trade on the OTC platform, which is nothing but a market which is made up of only the banks and large financial institutions only. In case of NSE, it is an exchange-based platform. There will be a difference between the premium of both the way. The major difference between you covering any of your exposure on the OTC platform as well as on the exchange platform is, in case of exchange platform, whatever hedging you are doing, that need to be cash settled. In case of banks, you can instead of you canceling and net settling your deal, you can utilize the forward deal or the option deal, whatever you have covered with the bank.
Can I add a few points, if you want?
Yeah, Abhishek, sorry.
Yeah, basically these are two different and dynamic markets. So the counterparty who is entering into the transaction with the person who is looking forward to hedge are completely different. On the OTC market, as Arpan has told, it is only the banks who take a counter position. But on the exchange, these are a lot of participants. I told you the list of participants who are there. So the price of the contract, or probably the price discovery, is completely different, completely dynamic in both the markets. So depending upon the expectation of the market or the participant, there are a few price change or probably price arbitrages which are available or which are expected in the market because of its own inherent way of working. So yes, there are a few differences at point of time. You might find banks being favorable in terms of your premium, and in terms of some market conditions, you will find exchange to be more favorable in terms of the premium which is available for hedging a tenure of a contract. So you can take wise decisions on that if you are able to have access to both the worlds. That is what I would like to conclude.
There's another question, which is from Dr. Kishore. He's asking, like, is forward premium income for an exporter as mentioned by the speaker? Request clarification, please. So, like,
basically, the way forward premium is an additional cost for an importer. Today, if rupee is trading at say 73, and after 3 months, 3-month forward is costing you 74, for an importer, it's an additional cost. But as far as an exporter is concerned, right now the prevailing rate is 73. But by booking forward, you are eligible to get a higher conversion rate of 74 if you're booking a forward contract for 3 months. So it's kind of an additional revenue which you can generate by locking in your rate today only, and that's because rupee is a currency with a higher interest rate, and since by converting your by hedging your exposure, you're converting your liability from foreign currency to INR, you're getting a higher rate.
Anybody is raising hand, like? No. So we have just received these 3 questions as of now, like, and in case of any further questions, participants can mail or send a message in the group to us, so that, like, we can take forward and ask the queries from the respective speakers. Since we are running short of time, I request the participants to pose their queries accordingly. And now I would request our chair, Bank. Yes, sir.
Before we move to the vote of thanks or concluding session, I have a request to the distinguished speakers. Maybe they can share a small note on the subject what we discussed. we have a monthly magazine. We carry the articles of interest to the industry, so we can publish in the magazine. So I request the speakers to share their brief note on the subject. And also we can plan a help desk at FTCCI. Now online we can have it, where the members, they can raise the query, and one of the nodal officer on one point of contact from NSE or ICICI Bank can be provided, so that we can pass it on that question to you and you can clarify to the members. So
Fine, sir.
yeah. We thank on behalf of FTCCI to the distinguished speakers for sparing their valuable time and addressing the today's webinar on global economic outlook and hedging forex risk. We like to have more continued such sessions interesting to the members, where we can create awareness about this subject, and we would like to have more and more awareness program on this. So thank you all the speakers for being with us. Thank you very much. And I thank all the participants for being with us for this session. Thank you.
Thank you very much.
Thank you, sir. Thank you for giving all this opportunity.
Thank you.
Thank you. Thank you.